The words were spoken at 2:47 p.m. Eastern Time, not in some shadowy backroom deal, not whispered through diplomatic channels, but broadcast live from the White House East Room. Scott Bessent, the U.S. Treasury Secretary, stood shoulder to shoulder with President Donald Trump, his expression carved from granite, as he stared down the camera and delivered the ultimatum that would reshape the global economy overnight. If China persists in propping up Russia's war economy by purchasing their oil, we will impose tariffs of up to 500% on every barrel that crosses into Chinese territory. 500%. Let that sink in. Not a typo, not a bluff, but a nuclear option in economic terms. The kind of move that doesn't just raise prices, it detonates supply chains, ignites inflation, and forces every nation on Earth to pick a side in what is no longer a trade dispute, but a full-blown currency war. The room froze. Reporters' pens hovered mid-stroke. Advisors exchanged glances that screamed, "Did he really just say that?" And in Beijing, halfway around the world, the response was swift and surgical. No fiery speeches, no public outrage. Just a quiet directive from the Ministry of Commerce. All new export licenses for rare earth elements to the United States and its key allies suspended indefinitely. Rare earths. Those 17 obscure metals that sound like something from a sci-fi novel. But in reality, they are the lifeblood of modern technology. China doesn't just dominate the mining. They control 92% of a global refining capacity. That means the high-powered magnets in your fighter jets, the semiconductors in your smartphones, the electric motors in your green energy vehicles. All of it runs through Chinese processing plants. And with one stroke of a pen, those plants just slammed their doors on the West. Within hours, the markets reacted like a body in shock. Gold, that ancient barometer of uncertainty, shattered through $4,200 an ounce, as if the barrier was made of glass. By the Asian Open, it was pushing $4,400. London traders piled in, driving it to $4,550. And when New York woke up, the futures desks were already bidding it toward $4,700. This wasn't speculation. This was survival instinct kicking in on a planetary scale. Jamie Dimon, the unflappable CEO of J.P. Morgan Chase, the man who has dismissed gold as a pet rock for over a decade and a half, appeared on a morning financial show looking like he'd aged 5 years overnight. His words cut through the noise. In an environment like this, where policy risks are escalating unchecked, a gold price between $5,000 and $10,000 per ounce isn't just possible, it's no longer irrational. Coming from Dimon, that's not analysis. That's a warning siren. The dollar's staunchest defender admitting that the safe haven might not be so safe anymore. Because this tariff threat isn't isolated. It's the culmination of years of escalating tensions. Sanctions on Russia that failed to cripple their oil exports, a growing China-Russia alliance settling trades in yuan, and a U.S. debt pile that's now towering over $36 trillion with no breaks in sight. Let's peel back the layers here. The 500% tariff isn't really enforceable in the traditional sense. Russian oil doesn't ship in neat, labeled tankers anymore. It's moved through a shadow fleet, hundreds of aging vessels with switched-off transponders, flying flags of convenience from places like Liberia or Panama, rerouted through intermediaries in Malaysia, India, and the UAE. Last month alone, Russia exported 7.4 million barrels a day to Asia, up from pre-war levels. You can't tariff what you can't track. But that's not the point. The point is the message. Washington is done playing nice. Join us in isolating Russia, or become the target yourself. But the world isn't lining up behind that message. Far from it. Bessent keeps invoking this global coalition against Chinese coercion. But let's look at the cracks already forming. Germany, Europe's industrial powerhouse, sources 93% of its refined rare earths from China. Their auto giants like BMW and Mercedes rely on those materials for EV batteries and electronics. Join the tariff war? They'd be shooting their own economy in the foot. Japan, with 87% dependency, faces the same dilemma. Their tech sector, from Sony to Toyota, would grind to a halt. South Korea's Samsung and LG, 81% exposed. Even allies closer to home are hesitating. Canada, With its vast natural resources, talks a big game about diversification, but still imports critical minerals processed in China. Australia has Lynas, the world's largest non-Chinese rare earth mine, but even they ship raw or to Chinese refiners because building independent capacity would take years and billions. And India? Forget it. Russian crude is flowing in at discounts of up to $15 a barrel below Brent prices, keeping inflation tame and factories humming. Asking Prime Minister Modi to cut that off is like asking him to spike his own voters' fuel bills right before an election cycle. So the coalition is more mirage than reality, a press release alliance where everyone nods in agreement, but no one commits troops, or, in this case, tariffs. Meanwhile, the unintended consequences are piling up. U.S. semiconductor firms are already warning of cost explosions that could add 20% to chip prices. Automakers project EV battery production dropping by a quarter if rare earth supplies dry up. And defense contractors? They're quietly briefing Congress that fighter jet programs could face delays measured in months, not weeks. But the real story, the one that's sending gold parabolic, is the accelerating shift away from the dollar. 56% of Russia-China bilateral trade now bypasses the greenback entirely, settled in yuan or rubles. India and Russia have inked a rupee-ruble swap mechanism. Saudi Arabia, the linchpin of the petrodollar system for 50 years, just completed its fifth yuan-denominated oil sale to China. Even traditional U.S. allies, like France's Total Energies, are accepting yuan for liquefied natural gas shipments. This isn't de-dollarization as some fringe theory. It's happening in plain sight, invoice by invoice. Foreign holdings of U.S. treasuries tell the tale. They've plunged to $6.2 trillion, the lowest since the depths of the 2008 financial crisis. China alone has offloaded over $40 billion in the past 2 months, redirecting into gold reserves, infrastructure, and domestic tech funds. They're not dumping in panic. They're diversifying with purpose, building parallel financial rails that don't run through New York or Washington. And every belligerent statement from the Treasury just greases those rails. When Bessent doubles down, calling this China versus the world, he's not rallying allies. He's giving them more reasons to hedge. Investors aren't chasing yields anymore. They're fleeing policy volatility. U.S. fiscal debt is a ticking bomb. Tariffs are fanning inflation flames, and the Federal Reserve is caught in the crossfire, delaying rate cuts that could ease the pressure. Gold surge mirrors this distrust perfectly. It's not about greed or speculation. It's about preservation. For 5,000 years, through empires rising and falling, gold has been the ultimate vote of no confidence in paper promises. And right now, the bids are flooding in because the promises feel thinner than ever. Dimon's pivot isn't isolated. Bank of America surveys show the biggest shift into commodities since the 2020 pandemic lows. Morgan Stanley analysts are modeling scenarios where gold hits $6,000 if the tariff bluff gets called. Even the IMF's latest currency report shows dollar reserves at global central banks dipping to 57%, the lowest since 1995. Incremental? Yes. Inevitable? Looking more so every day. Back in Washington, the whispers are turning to worries. Senators who cheered the tough talk are now fielding calls from constituents about rising costs. Corporate earnings calls are laced with tariff risk disclaimers. Apple supply chain execs are modeling delays in component deliveries that could shave points off quarterly shipments. Tesla's battery output projections are being revised downward. The S&P 500 dipped 5% in the first trading session post-announcement, while gold tacked on another 12%. But Beijing isn't just reacting. They're counterpunching with precision. Last quarter, they unveiled a $48 billion state fund for semiconductor self-sufficiency, aiming to replace U.S. and Taiwanese inputs within 5 years. If they pull it off, tariffs become moot. China exports finished tech without a single Western vulnerability. That's the long game, turning economic weapons against the wielders. Europe watches from the sidelines, inventories of natural gas solid, but industrial demand crumbling under the uncertainty. The European Central Bank warns that commodity fragmentation could shave 0.5 percentage point off annual GDP growth. 65 billion euros vanished yearly in a 16 trillion euro economy. When Bessent pleads for solidarity, what they hear is the prelude to recession. In Tokyo, policymakers debate in hushed tones. 80% of Japan's rare earths come from China. Switching to Australian sources means quintupling costs and waiting years for new refineries. A leaked memo from a senior advisor captures it. Symbolic unity cannot come at the expense of real economic security. This is the coalition's fatal flaw. Every member runs their own risk calculus, and none align perfectly with Washington's. Threats breed hesitation, not harmony. As the dust settles, or rather, as the gold dust keeps rising, the bigger question emerges. If the U.S. can threaten Armageddon-level tariffs and still end up sounding uncertain, what does that say about the system's foundations? Bessent's latest podium appearance shifted tone. We don't seek to harm their economy, and we trust they feel the same. It rang less like strategy, more like supplication. Markets didn't miss the nuance. Gold jumped another 3% that hour. Because uncertainty isn't a bug in the system, it's becoming the feature. The endpoint? Not collapse, perhaps, but a multipolar world where the dollar shares the throne uneasily with yuan, euro, and yes, gold. De-dollarization won't happen in a flash. It'll erode like a coastline, wave by policy wave. Gold just crossed $4,800 this morning. Traders are eyeing $5,000 as the next milestone. Dimon's words echo, the rational value of gold rises when trust falls. Simple, profound, unavoidable. The vault doors are swinging wide. The price is climbing. The choice is yours. Cling to paper promises in a storm, or anchor to something that has outlasted every tempest humanity has thrown at it. When the music stops, and it will, the prepared won't be the ones panicking. They'll be the ones weighing their stacks, watching the world realign. Like this if your instincts are firing on all cylinders. Subscribe if you're ready to navigate what's coming. The next chapter in this saga isn't written yet, but the ink is drying fast. Stay vigilant, stay hedged, and above all, stay golden.